Before I begin my presentation, allow me to introduce myself. My name is Amanda Saralaya Anakmila and I am currently taking Bachelor of Finance. In this presentation, it will consist of definition of capital structure, determining optimal capital structure, factor that affect capital structure and decision, factor of financial distress, the integration of tax and financial cost distress, agency cost of equity, pecking order theory, and the signaling hypothesis. By delving into the captivating of capital structure, I aim to fulfill the requirement effectively and deliver comprehensive and engaging insight into capital structure performance by providing the content as follows. Let's begin my presentation with the definition of capital structure. Capital structure refers to how business finance its overall operation and growth through diverse sources of capital. It is a key topic in corporate finance. It includes the proportion of debt and equity that the business utilizes to finance its operations, influencing the organization operational plan, and overall financial health. Debt and equity are two parts of capital structure. Debt has expiration date of less than a year includes commercial papers, credit line, and short-term loans. Meanwhile, for equity, equity represents ownership in the company. It includes common stock, preferred stocks, and return earning. A well-considered capital structure can enhance a company's ability to finance its activities efficiently. Next is the factor of determining optimal capital structure. There are three of it. Number one is cost of capital, whereby a business can reduce its cost of capital and boost profitability by having an ideal capital structure. A corporation with an ideal capital structure also has a higher market value since it has the proper amount of debt and equity to finance its assets and future expansion. Number two is financial flexibility, whereby maintaining financial flexibility to firm to adapt to unexpected opportunities. In this case, companies need to maintain flexibility to raise funds in the future. Excessive debt can limit this flexibility due to existing obligations and restrict covenants. Last but not least is business risk. High business risk necessitate a lower debt ratio to avoid compounding operational and finance risk. Firms with a stable and predictable cash flows can afford to take on more debt. Meanwhile, for businesses with volatile earnings should rely more on equity to avoid the risk of financial distress. Next is the factor that affect capital structure and decision. There are three of it. So number one is financial flexibility. A well-balanced capital structure offers the flexibility required to deal with shifting market conditions, which mean more profitable companies tend to use less debt as they have sufficient internal cash flows to fund operations and growth. Number two is risk management. Steady with cash flows may afford more debt and profit may want to hold more stocks. In this case, the ability of company to access capital market, which is both debt and equity, affect its capital structure. Firms with better access can choose the most favorable financing option. Lastly is market condition. Borrowing costs are lower when interest rates are low. Debt become more alluring. Prevailing economic conditions such as interest rates and investor sentiment may affect the cost and availability of debt and equity. Favorable market conditions can make equity issuance more attractive. There are three factors of financial distress. Number one is excessive debt accumulation, whereby the ability to make decisions and create a various cycle where one must borrow money to pay off debt, which mean high levels of debt increase the burden of interest and principal repayments, which can become unsustainable if revenues decline or costs rise. Number two is difficult to pay salary, which means it can be forced to make tough choices as a result of these circumstances, including expenses, firing work, or even shutting down operations, whereby a flawed or outdated business model that fails to generate sufficient revenues to cover costs can lead to financial distress. Last but not least is inefficient money management. To those who practice poor financial management may find themselves overspending, not enough saving for emergency, or mismanaging their credit. In this case, poor strategic decision, lack of oversight, and ineffective management practices can lead to financial difficulties. Next is the factor of integration of tax effect and financial costs. There are three of it. Number one is economic conditions and industry specific dynamic. It may have decreased sales and customer demand during recession, whereby a different industry are impacted by economic cycles, which means business may have decreased sales and consumer demand during recession, which raises the risk of financial difficulty. Number two is unique quality, whereby having a consistent and reliable cash flows are better and able to pay off the debt. Business that have a lot of physical assets can take on additional debt to manage costs and take advantage of tax benefits. Last but not least is the interest rate and investor attitude, whereby low interest rate lower borrowing costs, which mean increase the appeal of the debt financing. By keeping eye on market condition, businesses can strategically manage their debt financing plan to maximize the tax advantages and minimize the distress expenses. Next one is the factor of agency cost of equity. There are three of it. Number one is when managers know more about the company operations and prospect more than the shareholder do, there is an information asymmetry, whereby there are 2 points inside the information asymmetry. Number one is moral hazard, used to assess the information and pursue personal endeavors of shareholder. Number two is unfavorable selection, whereby difficult to determine the underlying value and the risk profile of the company. Number two is risk preferences, whereby investor can balance firm specified risks through their varied portfolio. It is because they depend on the company for their livelihoods and may have personal financial stakes in the form of stock option. Managers may be more risk adverse. Last but not least is incentive and objective. It may cause decisions to be made, such as empire building or excessive investment in non-core activities that are not in line with maximizing shareholder, which means shareholder often have a long-term view on the firm's worth and growth potential, but manager may concentrate on short-term performance indicators in order to increase their pay and job security. Next one is picking order theory. So picking order theory was first put forth by Stewart C. Mayer and Nicholas Majlub in 1984. It is proposes that businesses should order their financing alternatives according to least resistant or lowest cost, mainly to reduce information asymmetry. There are two factors under picking order theory. Number one is debt financing, whereby it's enable businesses to retain ownership and control without diluting the holdings of current shareholder, which means tax benefits associated with debt such as interest deductibility, can reduce the total cost of financing. Number two is issuing equity, which means the associated issue fees and other negative signaling consequences. In this case, the company stock may be overvalued when it issues new equity, which could cause negative market reactions and possibly dilute the ownership of current shareholders. Lastly is signaling hypothesis, whereby this theory was first put forth by economics, which is Michael Spence and Joseph Stiglitz in the 1970s, whereby it suggests that companies may deliberately take steps to provide investors with reliable information, thereby affecting their expectation and perception. Comprehending the signaling hypothesis illuminates how companies handle their investor communication and how financial markets process and react to this signal. There are three factors under signaling hypothesis. Number one is signal quality, whereby it may serve as direct and indirect gestures of potential or worth of company. For example, company can communicate with investor by using certain financial actions or signals. Number one is indirect signal, whereby it includes adjustment to capital structures, management pay, or investment spending. Meanwhile, for direct signal, it include things like dividend payments, stock buybacks, and debt issuance. Number two is creditability of signal. Signals need to be trustworthy and dependable in order to be effectively, which means investors have to think that company action reflect its actual financial situation and prospect for the future. Last but not least is the market response. The financial market modify the cost of the capital, stock prices, and expectation for future performance, which means negative signal may result lower stock prices and greater financial costs. Meanwhile, positive signal may raise stock prices and facilitates better access to finance. That's all from me. Thank you for your attention.